I'm going to welcome Corvin to our community. Corvin, I'm making you the presenter, Corvin Cordirla. And Corvin's a teacher, a mentor, a trader. Looking forward to having a conversation with you, buddy. So how are you?
Very good, very good. How are you? Thank you very much for having me.
Nice to hear it. Yeah, nice to hear your voice again, buddy. It's been what, a couple of years at least?
1.5 roundabout, yeah.
Yeah, so what's been happening in your trading life in the last couple of years? I know that you started marketing your FX Master course. How's that been going?
It's been going well. I suppose the target audience are people who take a step back and want to look at the bigger picture and are looking for ways that the market will pay you, which was the core concept of the course. And I think it's what's really interesting is if you look since last November, since the elections, or even if you look since 2009, I mean, equity markets have had a phenomenal run, to say the least. And what's really remarkable is that the number of people who are calling for correction is just increasing by the day. The number of tweets you see on the VIX reaching all-time lows and how that bodes badly for the market is also increasing. And you know what? I believe at some point there will be a correction, because there always is. But my bet, my money is that the day that where everybody throws their towel in and says, I can't take this pain of being short anymore, that's when it's going to happen. And right now there's just too many.
How are you going to know that? How are you going to know? Because I want to know too. How are you going to know we've reached max pain? Is there a number on the market? Is there a number?
When you stop seeing people tweeting about it, when everybody says screw it, let's just go long. I mean,
okay. Well, I think it's today.
4,000.
How about that? I think it's today that you're going to start to see a correction. So call me Dale's crying wolf again. But we have some interesting numbers here. So it looks like we're looking at the bond chart right here. Is that correct?
Yeah, no, that's true. I wasn't going to start out with that, but it just happened to be up here.
Oh, okay.
If you want to chart here, see if you can recognize this. Well, I suppose it's already labeled in the chart. This is not. That's the wrong. It's certainly the same.
Okay.
Kind of the wrong asset class.
So we're going to play.
Yes. Check.
So what is this at 77 cents?
No,
I don't know.
This is the stock index in Brazil.
Oh, okay. I never would have guessed.
So it's up. I mean, MEX is doing the same thing. DAX just is doing the same thing.
India we showed earlier.
So
all the emerging markets have outperformed the U.S. Is that the point?
No, the point is even dollar Brazil. So Brazil is appreciating a phenomenal character at the moment. What I'm saying to you is all markets, doesn't matter if you're in Botswana, Alaska, Mexico, New York City, London, it is going up. Global. So it's a global phenomenon. And this is what's really, really exciting. Everything is breaking up. It's not just disconcerted like it was in the last 10 years. It is going up. And I just, for the last 2 years, I've been saying S&P is going to go to 4,000, and it's definitely going to get there. And I think
what's going to 1,000?
The S&P will be getting to 4,000 very soon.
4,000
over the next 1 or 2 years.
Yeah, I've seen 4,200 by Peter Temple with one interruption, but he's pretty good. So yeah, that's an interesting number, 4,200. So you're a proponent of the narrative of a synchronized global recovery.
Yes, and can I offer you a catalyst? No, not necessarily. I can offer you lots of stories. But what I'm saying is that there is a trend. And do you want to be in front of it, or do you want to go with the wave? I think you definitely want to go with the wave.
Okay. So what do you do here?
Well, so this is an interesting question. Let's take a step back and think about, what is it that people tend to look at when they look at the markets. And so a lot of people, the first information they see is this visual representation of price bars. I mean, remember, this ability to chart prices is just a very recent phenomenon. When people back in the 80s or 70s were sitting in front of quotrons or market makers had to quote the clients, all they saw were just, price flashes on the screen. So I think there's a big difference.
I had charts, but I had to update them by hand.
Exactly. So I think, one thing that's happening is that this visual overload allows the brain to try to see a lot of things that sometimes might not necessarily be there. Number one. Number two, time is incredibly important to investors. And I feel that not enough people give time the importance it has. And I'll tell you that the number one factor you realize that time is so important is that boredom and restlessness usually leads people to overtrade, which is the single most or the second most biggest cause for people to lose, the first one being over leverage. And so what you get when you look at these charts is a visual representation with time completely squeezed, because obviously a year doesn't just go as fast as you might think by just looking at the chart. So when you look at a chart, especially over the period of a year, you think, oh my God, there's been a lot of action. When you actually sit in front of the screen during the day, this thing is not moving, it's not budging. So I think when you trade, you need to take a step back, you need to actually visualize or try to represent what is actually going in which direction, and maybe come up with a reason that's valid enough that you feel confident about. And once you have that, you need to construct a portfolio, because trading one asset isn't going to do you a lot. It's interesting, a lot of people say, I'm going to day trade, but I'm going to live this kind of free lifestyle of empowering myself. So I'm not quite sure how it is you're going to empower yourself if you're going to sit in front of the screen for 10 hours a day and sweat bullets. So the whole point is take a step back, use the right kind of leverage, construct a portfolio that represents your view. And so
less is more. Less is more, right?
Oh, absolutely. I mean, if you can end up having a portfolio where you rebalance once a month or maybe once every 2 weeks, trust me, you're living in bliss, you're living in paradise. And so the message here is, if you're going to look at any of the markets and try to find some sort of narrative that's going on here, it's, yes, global recovery. The equity markets are certainly indicating it for whatever reason. Okay, central banks might be piling money in, and we might now come to a halt because they're going to stop or start to decrease their balance sheet, and maybe Yellen's going to go out and the hawk's going to come in, and God knows what's going to happen tomorrow. But today you're getting a clear signal globally. So forget about what's going to happen in the next 24 hours, but today you're getting a very clear signal about what the market wants to do. And what the market wants to do is sell bonds, buy equities, be short the dollar, and in any case, be long commodities. So, okay, so you have that vision of the world. So maybe you're not quite sure, so dig around a bit, find some reliable sources that kind of corroborate the numbers. And by that I mean, look at some economic indicators. What's the PMI doing? Are manufacturers on the up? What's inflation doing? Because inflation tends to be, inflation goes up, you're screwed because everybody's going to raise interest rates. And so that seems to be under control. Just, have a look for what economically is going on around you, and then construct a portfolio that expresses that, and preferably with instruments that are not going to require you to maintain them like a pet. I mean, it's great if you have a view on a single stock, but they don't call the Russell 3000 for nothing, because it's got 3,000 stocks. So which one are you going to choose? You're going to go with FANG, you're going to go with utilities, you're going to do cyclicals, non-cyclicals. I mean, God knows what you're going to do. So all you really have to do is either buy the Russell 2000, which as we just saw is going up, 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 or you buy the S&P. And similarly with bonds, I mean, bonds are wonderful instruments because they just, it's the gift that keeps on giving. Not only do they roll down the yield curve, but you also get paid coupons. And so ultimately, go out and buy a bond index. And nowadays with ETFs, people have wrapped and allow you to track anything under the sun. So, in the States, you've got the AG and you've got the SHY and the TLT and whatever else you can find on the bond stuff. So buy yourself a couple of bonds, get some equity under the belt. Look at some commodity ETFs. Maybe you want to put a momentum overlay on top of it, and go short the dollar index, and live happily ever after. So what I'm really trying to get across here is a global view of what's going to go on.
You put these on all at once, Corvin, or do you kind of leg into constructing a portfolio? Here I am. I'm a new client of yours. I'm taking your course. I'm flat. I have 100 grand. What do you do?
Yeah, so the core concept of the course is to actually go statistical, meaning everything you do has to be tested. And so the interesting thing is what we just discussed here is that you construct a worldview, and that's a very heuristic approach. So what's a better way of creating a portfolio so that you can actually replicate the process historically? So one way to do that is to base it off easily available economic data as well as price action. By price action, I'm talking about basic momentum or mean reversion stuff like, how far has it overextended. And then the real question comes down to how volatile is the asset and how much does it correlate to the other assets. I mean, the whole point about buying a portfolio is that, let's say, so why would you want to buy bonds if you have equities? Well, the reason is because, if equities do go belly up, the bonds are going to be there to capture you. It's about the hedging benefit between these two assets that you're acquiring. So the first thing to do is to actually get a grip on how do you measure the volatility and then how do you measure the hedging benefits of the relative assets. And then the next question, which is the really important question, is to ask yourself these two things. Number one, how much are you willing to lose? And from my experience, having run a fund and having asked this question hundreds, if not thousands of times of investors, whatever you believe you're willing to lose, divide or multiply that or divide that number by 2. So if you're coming to me, you say, I've got $20,000 to invest and I'm willing to lose maybe $2,000 over the next 12 months, I can guarantee you by the time you're losing $500 or $1,000, you're going to be a nervous wreck. So once you know how much you want to lose or can lose and where your hard stop is on your portfolio, just use the statistics about the assets you have to construct a portfolio that stays within those boundaries. And that's
I understand the rationale, but I also believe that this would be a very difficult time with a lot of asset prices pretty stretched, even though the trend is up, to say to new money what to do in here. So I'll ask the question again.
This is a wonderful thing. I just love what you say in terms of asset prices are stretched, and it's very difficult to say the new money to get into here. So this is what I call a puke trade. This trade makes you want to vomit, and you know what? The best trades are the puke trades. It's the trades that you're just so scared to go in, but everything is pointing in that direction that that's the only thing you should definitely do. And the reason it's called the puke trade is because, trust me, everybody's still so scared that by the time that they just see the train running away from them, they're just all going to pile in. So let me actually bring up a chart of the S&P here, because we heard the word parabolic before, and parabolic has actually a very important meaning in terms of market dynamics and market crashes that follow. So this thing does not look like a parabola. It's been churning like crazy. What looked like a parabola was the NASDAQ in '99. That was a parabola, and then it went belly up shortly after. This thing is grinding. You don't crash when you grind. So what's happening at the moment is a lot of people are just sitting on the sidelines, and they just think, oh my God, I'm missing out, and what's happening, and Trump definitely will come through with his tax stuff, and the world isn't that bad a place, and yeah, maybe they slapped a couple of people around in Spain, shot a couple of people in Vegas, but you know what? The world continues. So maybe I should pile in. And by the time everybody thinks that, that's when you should get scared, because guess what? If everybody's buying, then they don't have anybody to buy from, and then the only thing left to do is to sell. So that's why, in terms of indicator, when this thing is going to crash, count the number of tweets every day that talk about a correction. When that number goes to 0, your S&P will correct. Until then,
what's it averaging now? Are you tracking that?
No, it just came to my mind. I'm going to start tracking that. Over the last year or so, I've become really obsessed with Python, which is a wonderful programming language which allows you to connect around about anything on this planet. So I'm building up the tool set. One of the ideas was to look at sentiment, but I think, what I just said actually probably will be really, really interesting in terms of a counter indicator, because you always want to do what everybody doesn't want to do. You always want to be in the minority. I mean, being a good trader means playing the minority game. You always want to be on the opposite side of what everybody else is thinking.
Even the commercials?
Commercials tend to, hedge. Commercials tend to be opposite anyway, because from their perspective, they just want to lock in.
Your volume went soft.
Speculators that you want to follow, and it never has been clear to me that this commitment of trade. Can you hear me?
Yeah, I can now again. Thank you, Corvin.
Hey, I don't know.
I could hear you.
I can't hear you. Can you hear me?
I could hear you. Yes.
Hey, can you hear me now?
Yes.
Oh, I suppose I couldn't hear you. Sorry about that. So no, what I'm saying is the commitment of traders report is really interesting, but I've never managed to squeeze any sort of statistically relevant relationship between price action and between what the what those things tell you. I mean, the other one is it's very difficult to work on levels, no, because as you can definitely see, it's always the relative kind of price or levels between these commitment of trader reports that are relevant or not.
Okay. All right, so we want to be in the minority. The narrative is this is not parabolic yet. It's on.
Does it look parabolic to you in any sort of way?
Is this a daily?
Yeah.
I think if you go to a longer term chart, it looks a little bit more parabolic. If you go to a weekly or a monthly. Yeah, that kind of does.
Okay. Okay. Well, see,
that kind of looks like it's that, you know, if you draw a parabola, you could call that a parabola.
I could also call it a straight line, which is, you know, this is, I suppose, the wonderful thing about markets. Two people can look at it and see something completely different. That's why you'll always have buyers and sellers.
Okay. That's my opinion. And on a monthly, it would even look more parabolic. But what do I know? I'm just a blind squirrel in the middle of a snow-covered forest on a moonless night, wearing my shades, trying to find a few nuts.
You know, that's true for all of us, including myself. You're absolutely right.
Okay. So how are you positioned with where markets are now? Say you were flat, what would you be doing in here?
Okay, so I focus on currencies, and so I wanted to go through some currency ideas. And
okay,
again,
that'd be great.
The notion of what does it mean to have a long-term perspective. So first of all, let's start out with
being bearish the dollar is part of your narrative.
Being bearish the dollar is part of the narrative at the moment. That's sort of two facts here at the moment. One is momentum. The other one is that you have a rebalancing in terms of what people perceive as value in the currency market, as well as not necessarily the most clear of signals out of the States as to what they're doing with interest rates. I mean, interest rates are not always about, you know, looking in the past and what has happened to interest rates, but about people's expectations as to what will happen in the future. And there is uncertainty around that. And that's, I think, why, you know, what we saw was phenomenal dollar rally at the start of the year. And then all of a sudden the steam just left the boat, the wind went out of the sails, and the thing just started to trail off. Actually, the dollar index had a phenomenal sell-off over the last 6-7 months, and it doesn't look like it's necessarily going to ease off. But let's take a step back here. So if you look at currencies, what is it? What are the underlying factors here you can focus on? So obviously, currency is the exchange of two pieces of cash, one for the other. So for instance, if you live in England or you live in Euroland and you want to go to the States, you have to take your euro bill and you have to exchange it for a dollar. So the question here is, can you associate a notion of value to these bills, to these pieces of paper? And the answer to that is yes, you can. How? Well, imagine this. Imagine that you have a bottle of water. So let's say you're in New York City. You have a bottle of water, and you're going. You're a tourist. You're in London, and you're thirsty, and you went to this newsstand. And you bought yourself an Evian bottle of water. Nice and round and beautiful, and you put it in your pocket, and you come back to JFK Airport, and you just realize, hey, I wasn't thirsty, I haven't drunk that bottle of water. So you carry it around with you, and then you come across another newsstand where there's another bottle of water, which is exactly identical, but it's selling for $1, not the pound that you spent. So if you're going to exchange one bottle of water for another, one piece of product that has intrinsic value, the exchange rate you're implying is 1 for 1, $1 for £1. But then you're looking at the market and you're seeing that actually the dollar is not going for £1, and it's like now at 132 or 133. So there's something misvalued here. The market is giving a particular price to the currency, but in the real world, there's another price. And so this is what people are referring to when the currency is overall undervalued. They're looking at the kind of exchange rate you could get in the physical marketplace when you exchange goods. So the next question you want to ask yourself is there a way of capturing this measure or this intrinsic value of currency when I exchange goods? And the standard measure for that is the purchasing power parity, which is PPP, and it's published by a whole bunch of international institutions like the OECD or the IMF or the World Bank. And you can go on there and you can look at these PPP rates, and you can, from those rates, determine which currencies are undervalued, overvalued. And so if you look at the kind of space that people usually tend to trade in the currency space, euro at the moment still is one of the most undervalued currencies on a PPP basis. And to a certain extent, Trump was right when he accused Merkel of, you know what, you're keeping this currency artificially low to benefit Germany. Maybe she's not necessarily consciously doing it. I'm not going to make any implications here, but it definitely is undervalued, which is giving Europe a massive benefit. And so to a certain extent, you have to counter that. I mean, at some point, the market's going to realize that, because you can't have a free lunch forever, and it's going to rectify.
Maybe you shouldn't have named Merkel, and maybe you should have named Draghi instead of Merkel.
What do you mean?
I think Draghi has a little more influence on the value of the euro than Merkel does, don't you?
Oh, in terms of the interest rates he sets. Yeah,
well,
yeah.
Okay, the value of the euro.
The value of the euro. I mean, yes.
Compared to Merkel.
I'm talking about the headlines that hit earlier this year,
okay.
when Trump actually directly accused Merkel.
Well, yeah. Okay, maybe he was right about one thing.
Maybe. So, so in any case, what you saw is, of course, in the last 6, 7, 8 months, the euro did definitely have a massive updraft.
Yeah.
The question is, what do you want to trade it? What's the most overvalued? So if euro is undervalued and has to go up, what's the most overvalued currency? And it's interesting in this particular case, in terms of overvalued, what naturally comes up is the Swiss franc. And there's been many structural reasons, such as safe haven inflows, as well as the depegging that went on, and then the natural rebound from that kind of situation. But the Swiss franc is still overvalued. So a natural position would be Euro Swiss, a long-term position. So I've got here a chart of Euro Swiss long-term, that this is on a weekly basis. So let me zoom in, and so that we can see exactly what's been going on since the last year. So this is since October 2015, and there's definitely been an updraft, a tremendous performance on this thing from 1.06 all the way up to 1.16, which is 6-7% over the last 1.5 years. Obviously, you trade this on your usual kind of leverage that people trade, which is 30-40% return. So that's pretty interesting kind of idea. Now the question is, will this continue? I'm not a forecaster. I don't have a crystal ball, but the conditions are still there. If you are more interested from a technical perspective, what is interesting is, of course, you've had that massive gap when the SMB pulled the plug from under the currency. The carpet from under the currency. Swiss just appreciated like crazy on that particular day, and we remember the horror stories from the back of that. But the gap hasn't closed yet, and there is anecdotal evidence that gaps do tend to want to close, and this thing is definitely going for it. And we know that you are strong, so you might want to think about scaling into a position, especially after the current pullback that you're experiencing. So if you go onto a daily kind of time horizon, you see that it's definitely finding support here. So now listen to the words I'm using, because this is quite interesting. I started out from what's the economics, what's the underlying fundamental story, and I'm now transitioning to where do I see the market turning. And what you'll see with many people who will talk to you about fundamentals, they will, when it comes down to the real short term about entering positions, talk to you about fundamentals, about support and resistance. And there's a reason for that. And the reason is macro trends tend to be things that develop over a period of 1 or 2 years. So to get the timing right is very difficult. And if you get the timing wrong and you're trading on leverage, it doesn't matter how right you think you are, and you might be in the long run, in the short term, you still might get squeezed. So at this moment in time, Euro Swiss definitely looks like a very interesting situation, certainly across a whole bunch of other outlooks indicators. Swiss franc at the moment seems to be weak. Seeming to be weak, let's move over from this idea of value to a slightly more technical idea of mean reversion in currencies. And you certainly have mean reversion in a lot of asset classes. So if you go back to equities, the equity market is really interesting because it's got some phenomenal bias. I mean, look, it's been going up since 2009. But remember one thing, equity markets have been going up for 500 years. I mean, this going up thing that people have to get into their heads. It's not a recent phenomenon. I mean, the people who are looking at the markets now obviously haven't been around from 82 to 2000, because that thing just did one thing and it went up. Even 87, it was the end of the day. Tudor Jones said it's going to be the end of civilization. We're going to be back with clubs, living on the trees, eating coconuts. None of that happened. It was just a straight line up, continued to be a straight line up. Equities go up. It's usually the crash that's the exception, and we don't get crashes every Tuesday. So I think the message here is that if you're looking for bias, is another big bias. We get turnaround Tuesdays. Another big bias in the equity markets is mean reversion. So what that means is that if something's been going up for a long time, you tend to find that it will stop doing that. And so a great time horizon is a 5-year period. Every 5 or so years, something that's gone up ridiculously high will correct. Now, interestingly enough, that's not just true for equities. It tends to be true for a lot of other assets, including currencies, and especially currencies, because currencies tend to be naturally mean reverting as well. I mean, when was the last time you saw a currency go from 10 to 100 like Yahoo did back in the 90s? These things don't go explosive unless they're emerging markets.
Bitcoin.
Oh God, yes, great, Bitcoin. Look, it has. Okay, let's get
even has you stuttering. Even has you stuttering.
It's kind of silly because I have no view on it. I mean, at this moment, the thing is, I can't. I always. This is really interesting. So my son actually calls me old. I don't feel old. But I think I'm getting to the stage of being old, and that means getting sort of old school. If I can't touch this thing, if I can't smell it, and bounce it around, it's not real. So this Bitcoin thing, I don't know. I mean, I can bounce a computer around if you want me to do that, but I don't know. It's difficult to say. Am I going to agree with Goldman Sachs or Jamie Dimon? I mean, Jamie Dimon thinks it's a lie and it's a fraud, and on the other hand, Goldman Sachs wants to set up and start looking at how to make Bitcoin real for them and their clients.
Yeah, and Jamie Dimon's traders traded in London, and he didn't fire them either. So, you know, that's Jamie Dimon.
Hey, that's investment banking for you. So going back to mean reversion, what you can ask yourself is, so which currencies were overextended? And so you can measure overextension in a very simple way. Just take your favorite currency pair and look by how much it moved over the last 5 years. And then what you do is, the currencies that appreciated the most you sell, and in this case I'm going to say versus the dollar, but you can say versus whatever base currency you choose, and the currencies that depreciated the most you buy. So in this particular case, it's Swiss yen. So as we saw, Swiss yen appreciate, you know, crazily and still is overvalued, but the yen is still fairly weak compared to the rest. And so this is actually a weekly chart of Swiss yen, and at the moment, Swiss yen, definitely, it's been a fantastic trade ever since it came up, which was back at the end of 2015 as being short Swiss yen. And I think there's still juice. And as I said, okay, so you have a view in terms of this thing should now, because it's so overextended, sell off at some point. And so when do you want to enter? And that's where the technicals come in. And, you know, yeah, I do say if you can't repeat and test, you shouldn't use. But given we're not here looking to test anything, we're just trying to do heuristics and we're trying to get comfort. Is there something that we can do? And support resistance, I think, is always a wonderful story to have, because it definitely represents levels where investors want to get in or not. And so what you see on this particular chart is the fact that you do have a triangle, and we know that triangles means congestion, volatility is getting scrunched. And that means at some point it wants to move in a particular direction, at least initially. So which way is it going to go? And the bias tends to be to the downside, and the fact that it's on the upper edge of this triangle, it just gives you confidence on a weekly chart. And so when you go down to the daily, you see, well, hang on, I'm having a lower high than I did before. It's looking weak. You know, this might be something to go for. And then I look at dollar Swiss, and I see that dollar Swiss has strength. And I see that Swiss is actually weak against a whole bunch of other currencies. So that gives me confidence. Hey, maybe Swiss yen is something to be looked at. Of course, it comes down to, okay, so if I go short Swiss yen, what's kind of my stop here? And that again goes down to, well, how much are you willing to lose, and that'll inform how much capital you have, and that'll inform you how loose or how tight you want to keep your stops. But the reason you tend to stop, think about it.
Your stop is based upon a money stop rather than a market stop.
Well, a money stop has to translate into a market stop, because you can't just go in, okay, I have $20,000 in my bank. I'm not willing to lose more than 1,000, but guess what? I'm going to leverage up and have a billion Swiss yen short. Yeah, that thing moves by a fifth of your history.
Yeah.
So where would you want to put your stop? I mean, again, let's go with what the market is telling you in terms of how much it decided to explore the space around it, which is what support resistance ultimately tells you. It's about how willing it is to get there. And at the moment, it's not being very willing to, let's say, go above this particular level. Now, is this a level that's set in stone? No, you can't forecast it. And that's the whole problem with trading. Trading is about making decisions under uncertainty. It's like you're fighting a constant battle. You've got bullets whizzing around your head. And the only thing you can know that you should do and can do is protect yourself. So wear a bulletproof vest, wear a helmet. I mean, if you're going to go trading without a bulletproof vest and a helmet, you're begging to be stuffed. And so the whole point, therefore, is if that's what you believe your hard line is for you, then stick to it. Set the stop there. Tell yourself, I don't want to lose more than that, and then go for the trade. And again, let's be very realistic, because it's all about how much are you willing to lose. If you think you're willing to lose X amount, divide it by 2. Why? Because you're probably going to have other positions on the line. And the other reason is most people lie to themselves. All investors I've seen who told me I'm willing to lose 10% a year, they were liars. After 2 or 3% loss, which, hey, you know, happens almost all the time, because that's what it means to trade. It means to take losses. These people are on the phone to you, and you think, well, how old are you? Do you know what this game is about? Go away. So be nice to yourself. Be actually realistic in terms of what you want to lose, and then set yourself a stop. Don't use a lot of leverage because you don't need to, especially in currency markets. And then you can sleep at night. You can forget about the position, and you can look at it maybe once a week and say, you know what, this is working out for me.
Okay. So anything you want to wrap it with, buddy?
Wow. Okay. So we're wrapping it already.
Okay. Well, you know, if you have more, it's fine. Usually I go a half an hour or so, but go ahead, man. You could,
I think an interesting one is, let's look at the upcoming news. I think a really interesting story is Aussie dollar. Aussie dollar against whatever currency you want to choose, and we'll have 2 of them. One is more against the dollar because that's the classic story at the moment. The reason I'm saying Aussie dollar is because, pardon?
And the other one's against Kiwi.
Yes, and the other one is against Kiwi, and the reason for that is because they tend to be neighbors.
Right.
And so that tends to be quite a nice mean reversion setup that you can actually milk for a lot of money if you have the patience to do so. In terms of Aussie dollar, we've got the retail sales numbers coming out tonight, depending which time zone you are. And certainly, most recently, if you actually look at what's been happening to inflation, so there's this wonderful website, Trading Economics. I don't have anything to do with it, and certainly the subscription fee is through the ceiling if you want to get the actual download data to be able to extract it. But you can do some nice plots, and you can see what's been happening to inflation to Aussie. It's certainly been squeezed lower, with currently floating at probably 1.9, and interest rates are topping out as well. And obviously, you're getting a lot of stories, if you look online, about how the fact that the housing market is completely overstretched. If anybody has to pay another 100 Aussie dollars on their mortgage, they're more or less going to go to the soup kitchen. And certainly on the ground, over the last year or so, having spoken to people in Australia, it is a catastrophe. The suicide rate in the mining sector is through the ceiling because these people over borrowed. Now they can't pay their mortgages back. It is, in Australia, it is a tough story at the moment. And so that's ultimately going to be reflected in the currency because it's overstretched. And so retail sales, these kinds of, you know, it's like death by 1,000 needles. The thing wants to go up, but it just doesn't know how to. It's like a dog with 3 legs. It knows where it wants to go, but it can't get there. And so if we bring up a chart of Aussie dollar, this is to a certain extent what you're seeing. Let me get rid of these hours, which just plot out daily highs and lows. Actually, let me not get rid of them because it's difficult. But as you see, it's been on a downdraft. It's trying to get up, but it's very weak. It's come to the resistance. And I think any kind of news at the moment that's coming, it's going to hit it. It's going to slap it. And so you just find that, you know, have a short bias on this thing, and then, you know, try to hit it at the right time and go with the flow. I mean, the bias is ultimately to the downside, especially because you have strong dollar recovery economically, whichever way you look at. Actually thinking about this, another great story with the Aussie is to be long, for instance, sterling against the Aussie. Why? Cable Aussie has massively sold off, especially after the Brexit and after the general elections. But there's something interesting going on with sterling, and that is, you know, people don't want to believe that England is going to turn into Botswana. I mean, you know, just because they're going to leave the European Union doesn't mean they're going to be eating bananas for the rest of their lives. And so that, to a certain extent, is being reflected in the fact that there is, again, strength coming into that currency. We've seen 133 as far as 135. Haven't seen that in a long time, certainly not after the collapse. If you look at sterling Aussie here, it's certainly based out and it wants to go higher. And as Aussie's going to sell off, sterling will go higher, sterling Aussie will go higher as well. So I think those two currency pairs are something to bear in mind. And what's interesting in terms of confirming that kind of Aussie weakness is this chart, Aussie Kiwi. Again, this is on weeklies. As you can always see, I pull up a weekly chart because I want to see the big picture. And what you can see over the last 3 years, which is this area over here, this thing has been going up, down, up, down, up, down, up, down. I mean, 3 years is a long time for something to go up down. You gain confidence that it is an up down kind of a thing. And so at this moment in time, one way to look at it is to want to go short this particular currency. Not because you necessarily have a view on Kiwi, but because you're taking a view on the behavioral pattern that this currency pair exhibits.
Okay. Nice look. Yeah, huge long-term range. So you have a negative bias. You think we could revisit a buck and take out the bottom of the range?
No, absolutely, absolutely. Now, this is certainly on a weekly basis, on a daily basis. So let's zoom out here. So again, you know, you're going to try to understand, hey, what's my risks here? So if I enter Aussie Kiwi here at 109, how far can I go? How far am I comfortable to go? Am I going to let it go to 114? Is that too far? Is that going to counter all the signals? Or am I happy to let it go to 112 and then see it go back down to 1? So there's a lot of different things you have to think about. Remember, the entries are not the most important thing. Nobody's going to make money on entries. They're going to make money on exits. And so that's ultimately what you have to play. You have to play it safe. You have to wear bulletproof vests. You have to have some sort of view you're comfortable with. And then you have to put your stops in the ground.
Thank you, buddy. Very interesting presentation. You want to show your website and how people could follow you?
Yeah. Let me just type this in. This thing in over here. That's okay. So let's take this out. So this is the website. So the website focuses on content. There's no ads. There's no buying opportunities here. It's me publishing. Actually, the last year was a bit crazy personally for me, so I haven't had that much time to publish. And I've just started a new article series last week, which there's been a big uptake from my subscribers currently. And it's about, you know, this idea of how do you build consistently profitable trading systems, what you have to measure. And as you know, as you can hear from what I said today, I started out with equities, and then I'm going to extend it to all the other asset classes out there. And the question is, how can an individual ultimately build up a portfolio of various asset classes and make money? And by making money, here's going back to time. Time is of the essence because we don't have much of it. So when people say, I want to make money, it's not about I want to make money over the next 1,000 years. It's also having to be realistic. I can't make $1 billion in the next 10 minutes. So there's got to be some space here. So an interesting question to ask yourself, and a lot of people don't ask that question, is over what time frame would I like to double my money? A time frame that seems realistic, doable, and is certainly within my means. And the biggest issue is a lot of people say, well, I'd like to get 20% a month consistently, day in, day out, and I'm going to day trade. Well, good luck to you, because it's not going to happen. The way to do this is to look at what markets have historically been providing you. And so when I say markets have been going up, actually, let me go into this article that came out last week, and I'm going to show you a nice chart, which I completely plagiarized from somebody else because I didn't do that research myself. And I'm going to show you what more or less happened to, actually, it's not in last week's article, I think. It's in this week's article. What happened to equity markets over the last 500 years, because I did mention that, you know, equity markets have been going up for 500 years. And I find that's always a very interesting statement, because the first question you ask yourself is, well, the S&P wasn't around 500 years ago. So how do I do this? Well, guess what? People have been trading equities for a long time. Remember the tulip thing? Well, that's been going on. And certainly the Italians had it, because the Italians were business people back then. So if you actually plot out an amalgamated kind of chart of what happened to the equity markets the last 500 years, this is what it is. Yes, you get ups and downs and you get crashes and blah, 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 but it's going up. And so once you understand the bias that a market can offer you, you have to ask yourself, how do I protect myself against the downdraft? And that's where the kind of entire construction business comes in that we were talking about earlier. And this is what this article series will explore.
That looks parabolic.
Yeah. It certainly does at that scale. You're absolutely right.
And what do you think? A little parabolic? Maybe we're due, let's see, fib in time, 500 a year bull market. We get a 38% correction in time. That would be, we're about due for a 200-year pullback.
Can you imagine? Can you imagine? Hey, here's another pullback.
I don't have to worry about it. How about you?
Well, here's another pullback. We haven't had a comet strike the Earth in 65 million years, and we're bound to have one because it happens in 5 million years.
Yeah, we'll be lucky enough to see it, huh, buddy? And it was really, really pleasure hearing your voice and hearing your, you know, your rationale and holistic approach to the markets. And, your view that you don't have to be a market timer, but just recognize undervaluation, overvaluation, mean reversion. A lot of pearls you dropped on us today, Corvin. Thank you
Hey,
very
thank you very much for having me on, and sorry for sort of rat-a-tatting at you at the moment. I haven't had much sleep in the last 48 hours.
All right, buddy. Well, rest well, and may pips rain down on you and your subscribers in the coming days.
Thank you very much for your time. Have a very good day.
All right. That's my trading warrior brother, Corvin Cordirla. So thank you very much, Corvin. See you F.A.C.E tomorrow, day before NFP. Don't just count your pips, count your blessings. Enjoy the rest of the day. And ForexAnalytix will be back with you and have your back tomorrow morning. Adios.